I wanted to take a few minutes today to walk through that cash flow modeling example that I've shown you in class and that we've worked up each of the last few days. I wanted to make sure that I not only showed you the structure and that you had a visual representation of it, but I also wanted to make sure that you saw and understood what's going on in most of the cells that you need to program or put functions, equations into, and cell references, rather than just have me talk it through with you in class as we did. I want to be very clear about how some of this comes together because I want you to not have to struggle when you do the assignment. And I want you to be prepared for the conversation that we're going to have about the bubble and B case on Monday. One of the things that you'll remember is that when I showed you my example yesterday in class, that we had an $822,500 out of balance. It occurred to me after I came back into my office that was because I had designed it that way so that you could see that we were out of balance because there was financing needed because this company ended up in a negative cash position. So as we take a look at this, then I want to make sure that you follow along what's going on there, why it's happening, and how to get it straight for yourselves. So we're going to take a few minutes and go through back through some of the various elements on this. So you see that we're once again dealing with the starting condition here in column D, and then I'm giving us periods 1 and 2. I'm going to walk down directly to the assumptions because that's where so much happens here. And in this case, I'm going to walk you through the model form that uses the price per unit and the number of units that we have as our target. And then I'll show you briefly the version of this that simply uses a revenue amount and then some targeted increases in revenues. You can do this either way. It just depends on the kind of business you're working on and the level of detail that you need to provide and whether or not you're trying to put together a break-even analysis as I have down here in these cells. I would encourage you to put together a break-even analysis. I think anytime that you're trying to propose a business opportunity or idea to someone, even if it's a business that already exists, evidencing that you have a sense of how many units of output need to be created and sold in order for this business to be viable at either a break-even amount, so zero profit, or some targeted profit amount is critical. I can't tell you the number of times I've turned business ideas away from people for investment when they haven't been able to tell me what output was necessary in order for the idea to make sense and to be above water. So as we go through this, I've simply made an assumption here. And again, everything that's in green is an assumption. The items in yellow are kind of quasi-assumption, maybe indicated to lead us somewhere else. And then everything in black and white results from the assumptions. So all of that is either hard-coded because it's text like price, quantity, total shareholder equity, additions, reductions to debt, that kind of thing, so labels, or it's cell references, equations, functions, all resulting from the assumptions. So as you remember, we started this by saying we believed that this company would raise $1 million in equity capital, $500,000 in debt, and then spend $1 million on new equipment even before they opened and did anything else. So we see the $1 million in equity here. We see the $500,000 in debt. We see the $1 million in fixed assets. And all of that then results in the beginning cash balance. And that beginning cash balance here is brought straight up to the cash balance up here, and then results in a subtotal for current assets. The asset purchase for $1 million shows up right here, results in this subtotal. We don't start with any accounts payable, wages payable, accounts receivable, inventory, any of that, because we haven't done anything yet. We do end up with the long-term debt that results in the subtotal here. And the long-term debt you can see is a cell reference down to the cell in which I indicate the starting condition with 500,000 in debt. You then see total liabilities, which are the sum of these items. You then see the $1 million in equity. That's a cell reference from down here in the $1 million of equity contribution. We don't have any retained earnings yet because nothing's happened. And when we do have retained earnings, they're going to be cumulative. That gives us total shareholder equity. And when we take total shareholder equity and liabilities, it gives us an equivalency to total assets, which is why in my little check digit structure down here, you do not see any value. So it's showing 0 because I'm taking one minus the other. So it's 0. If you see a value show up in this field, it's because something's out of balance. And remember that having a balance sheet that doesn't balance is the cardinal rule or cardinal sin of finance. So let's not have to go repent. All right. So everything in this column, all the way down through here, is the result of these assumptions. And I think that's probably pretty obvious to you. Now, an assumption I didn't reference is this number I have in here under depreciation. This number is intended to represent the number of years that I believe we can depreciate these assets for. And in this case, I'm using 5 years, and any additional assets that we acquire, I'm using the same 5 years. If you had a more complex set of assets, some of them depreciating in 5 years, some depreciating in 7 years, etc., then you might have to create an asset purchase and depreciation schedule. We'll go through that at another time in class, but not over the next week or so. So then, we also have as some starting assumptions that we believe we're going to create and sell a product for $50 a unit. And we believed that we could do maybe 10,000 units a month in the first year or two. But we went ahead and said, realistically, in the first period, which is a year, we're only going to forecast 25,000 units. So that's the 25,000. Those are input directly, and they result then in this revenue for each of the years. I'm going to go ahead and remove the green from these because you don't have to input those values. Those values are the result of these values that you already input. Well, you'll remember that we said we believed there was a $30 average variable cost per unit. And if the unit is being sold at $50, that means that there is a cost of goods sold as a percentage of revenues of 60%. You can think about this figure as though it is a forecast ratio of the type that we used in Finance 309. So we believe that every unit is going to have a 60% cost of goods sold for it. Good. We also believe that we are not going to have any additional selling expense over and above our total fixed cost that we are projecting for the first period. And we're not going to have any general and administrative expenses that are in excess of the fixed expense we have for the first year. And we agreed that there was going to be a $420,000 fixed cost, total fixed cost for this first period in which we're operating. Now, this would include our rent. It would include salaries to those people that are not directly associated and exclusively associated with production. It would include any marketing or advertising that we're doing that we have just given a fixed amount to, and many, many other items, utility, insurance, etc. And I think you understand fixed versus variable costs. And if you don't, then you need to go back to your Business 101 material and think about revisiting the last 4 years of your experience here. We agreed that there was going to be a 3% interest rate on this bank debt or this investor debt that we brought in when we borrowed $500,000 to help us start the company. So I'm going to think about this as investor debt. And I'm also going to think about our payments to this as being interest-only payments So this 3% is going to result in some values on the income statement. And I'm going to go ahead and also assume that each year, once we've gotten a little farther down the line, each year we may go ahead and start to pay off some of the principal amount of the debt. So I'd like this company to get to a point where it doesn't have this debt, of course. We'll go ahead and make the assumption that taxes are being treated at the business level, so 21% federal, 5% state to combine at 26%. And then we talked through some of how you would think about the expectations for assumptions for accounts receivable, inventory, and accounts payable. These get a little bit squishy in some people's minds. Remember that you can think of accounts receivable and then inventory, both current assets, and think about what amount of these is likely to be on hand at any time as a percentage of annual revenues. If you're dealing with 30-day terms, that's 1/12 of a year. So if everybody's paying you on time, and if your revenues every month of the year are constant, so they're the same, then you would expect to always have about 8 or 9% in accounts receivable balance. However, if people aren't paying you on time, then that might grow a little bit. Or if you give them 60 days, it might be double that. Or possibly if you have non-constant revenues. So some months your revenues are much higher than others, some months are much lower. And if your higher revenue months are at the very end of the year, you might have to think about this as being a bigger percentage as we go then into the next year and such. So you got to give some critical thought to this. Same thing with respect to inventory. And so we agreed that we would use a 15% or approximately 2 months for accounts receivable, 20% for inventory. So we're supposing that we've got to keep a couple of months worth of inventory on hand in order to satisfy customer needs, be able to get things shipped out rapidly enough to satisfy their demands, keep things fresh enough to satisfy your demands, and just keep a good balance there. Depending upon the industry you're in, you may need to have a much smaller percentage of inventory because your inventory may be consumable or your inventory may be perishable. But in other industries, you might have a year's worth of inventory on hand at any point in time. Depends on what you're manufacturing. So these numbers have to be critically considered. Same thing with accounts payable. And this is going to have to do with completely with when you are buying your inventory, how much inventory you're buying at different times of the years, and what credit terms your suppliers are extending to you. Now, in my forecasting, I have used here that we're taking accounts receivable, which will show up on the balance sheet, of course, as a percentage of revenue. We're taking inventory as a percentage of cost of goods sold. I very often will take inventory as a percentage of revenue as well. But in this example, I'm showing you cost of goods sold and then accounts payable as a percentage of cost of goods sold. I would always do accounts receivable as a percentage of revenue, and I would always do accounts payable as a percentage of cost of goods sold. I also have a little bit of wages payable here, and I've got them as a percentage of sales as well. And frankly, it is discretionary as to what they are a percentage of. They just need to be something that you're able to pay attention to, track, and calculate from. And in this case, recognizing that it's rare for the end of the pay period to coincide with the last business day of the month, we assumed we had a small amount of our annual revenues that resulted in wages payable. So we came to the end of the year and the pay period either hadn't finished or the pay day hadn't come. And so we had this payable. That kind of walks you through where these assumptions are and some of the rationale for them. Now let's look and see how they affect things. So we're going to the income statement first, and we'll go to the balance sheet. So on the income statement, I'm simply pulling over the cell reference where we have the revenues. That's easy. For cost of goods sold, I'm then taking that 60% times some, I'm taking 60% times the revenue because we said cost of goods sold would be 60% of revenue. And then I have a subtotal that is the gross margin. This is more accurately stated as gross profit, by the way. So I'm going to change this. Margin should be the percentage of gross profit as a percentage of revenue. So now we go along and we can see selling. Well, we don't have a selling expense here because we had a zero assumption, but notice that I'm interacting our assumption with the revenues. So our assumption down here is 0% with the revenues of $1,250,000 result then in a zero cost. I'm now picking up general and administrative. And this actually gets a little bit more complex because you'll remember we had general and administrative on two separate lines. One line is a percentage of revenue and one line is a fixed amount. So let's see how I treated that. So I go ahead and take the percentage of revenue times the revenue right here. And then I pick up the cost, the fixed amount right here. So you can see it's using both of those cells and the revenue cell, taking the fixed amount from E44 plus the revenue times the percentage forecast ratio that we might have put into that second line. Now for depreciation. You'll see the depreciation comes in here. I'm simply referencing it from where I got it. So let's go back and see how I calculated that. So I went ahead and set this up because of my assumption of 5 years. And I'm also making an assumption that we are picking up the equipment in it for any given period. We're picking it up at the end of the period. So we are depreciating what we had the prior year and before during any given year. And if we buy new capital equipment during that year, I'm assuming we're buying it at the end of the year. And so we're not depreciating it that year. We won't depreciate it until the next year once we've had it for a full year. Now that's an assumption. And you might be assuming that you pick it up halfway through the year. You might assume you pick it up at the beginning of each year. You might assume that you have an asset purchase and depreciation schedule that's on a monthly basis. I just tried to do this in a fairly simple way for you, and I chose to default to we're acquiring our fixed assets at the end of our period. And so we don't have any depreciation for them during that period. We have depreciation for them during the next period and so on. So you'll notice here that I've gone ahead and I've taken the asset of $1 million that we buy at the start and I divide it by 12, I divide it by 5, and that then gives me the $200,000. If you look at the next period, I now am taking the sum of the assets I have acquired over the years and dividing that by the 5, and it results in my $400,000. And we'll see then how that plays out in periods 3, 4, and 5 as I go ahead and open those up before I finish this discussion with you. So here's where I picked up the $200,000 of depreciation. And it resides right here. That results in total expenses. I would think that these are operating expenses, so I'm going to change the structure on this and call it operating expenses. And I'm going to say total operating expenses. I'm even going to go ahead and put a line under these because it's going to become important to me. You couldn't really see it there because we also have the boxes. But then this results in our EBIT, and EBIT's exactly what you expected it to be. It's gross profit minus our other operating expenses. So we ended up with a negative $120,000 EBIT. In this case, we have an interest expense of $15,000. So where did that come from? So I took the long-term debt on the balance sheet, and we're going to come to the balance sheet again in a few minutes, from the prior period, and I interacted it with the 3%. So why did I take the debt from the prior period? Well, again, I have to make an assumption as to when I pick up new debt. So I'm assuming that I pick up new debt at the same point in time that I'm picking up the new capital equipment. So we're spending $1 million on capital equipment. I'm assuming that we need to raise $500,000 to do it. So those are happening both at the end of the year. Since I didn't have that debt during the year, I am using the prior period's debt balance, not liability balance, but debt, long-term debt balance. Liabilities would include current liabilities for which we don't have an interest expense. I'm taking the long-term debt balance from the prior period, interacting it with the interest rate that we have, and then that gives me the interest expense. This is exactly the same way we did a forecast ratio in Finance 309 for interest. We then end up with taxable income that is EBIT minus our interest expense, so negative 135. And on a loss, we don't have an income tax, so I am going to input an income tax here that results in a net income of the same negative 135. So with that, let's think about the balance sheet. So we're going to start not with cash, we're going to end up with cash, but we're going to start at this, in this case, with receivables and work our way down. We're not starting with cash because this entire cash flow forecast serves to forecast our cash flows for the purpose of doing some valuation metric so we can identify NPV and IRR, but also so that we can solve for the cash on hand. And if the cash on hand is negative, then we've got a problem. We need to raise money. And we'll see how we might even complicate that just a little bit further later on. So in this case, we've got 187,500. Where did it come from? Well, it came from interacting that 15% assumption for accounts receivable down here with our revenue to result in that value. We then have inventories at 150,000. Well, where do we get these? We are interacting the cost of goods sold with our assumption of 20%. This then results, if you think about our cash and receivables and inventory, results in total current assets exactly as you would expect it to on a balance sheet. Let's go further then. So PP&E. We are showing, since we acquired the new fixed assets at the end of the period, we are showing those new fixed assets on our balance sheet for this particular period, year one in this case. And we're showing the gross fixed asset amount in this line, from which we will subtract accumulated depreciation to end up with a net fixed asset amount. This might look a little bit different than how we did it in some of our examples in Finance 309. As often as not, I would use a net fixed asset. So by the time I put it on the balance sheet, I would have already depreciated it. So what I'm showing you are two different ways. One way I showed you in Finance 309, another way I'm showing you now, two different, but both equally credible and within the construct of GAAP ways of showing your fixed assets on the balance sheet. For some businesses, frankly, I prefer to see the gross fixed asset and then be able to add new fixed assets to it so there's no depreciation taken on this PP&E property, plant, equipment line. But as I depreciate the asset, then I have an accumulated depreciation going on here, resulting in a net fixed asset. So where did I get the assets of 2 million? Well, I took the prior balance and added to it any new asset purchases. Where did I come up with the 200,000 depreciation? I simply reference it directly from my depreciation assumption. You might ask, why is it that I don't have this 200,000 and 400,000 as white instead of the green that I have? Since really, I'm not inputting those dollar amounts, I am letting them run as a result of an assumption that I've already made. So I'm doing this a little bit inconsistently with the way that I did it up here for revenue. But I prefer to keep it like this personally, because sometimes I will input this amount and sometimes I will use an interaction of some kind. So this is a personal preference. You can do it either way. I do it like this more than anything else as a reminder to me that I have to account for this. So we go back up, we see where that came from. We see that it results in net fixed assets, and our net fixed assets and our current assets result in our total assets. And then we can go down to liabilities. Well, accounts payable. I got accounts payable by interacting cost of goods sold with the ratio that we assumed for accounts payable. If I think about wages payable, I have the same kind of relationship here, but this time I said that we were interacting those with revenues. And so I interacted with revenues. Again, it's discretionary as to whether you have wages payable a function of revenue or a function of cost of goods sold. You have to have it as one or the other or some credible relationship. And I think it depends on the kind of business you're dealing with as to which is more likely to be the case. More important than any of that, the one you should use is the one that helps you manage the business and the one that helps you explain the business and its expenses. Well, this results in a total current liability of $150,000. Now let me look at my long-term debt. And you'll see here that my long-term debt is coming directly over from my long-term debt category. Well, that's an issue now. So I've got something going on here I need to think about. So I want to be very plain and clear as to what's happening here, and then we will resolve this to get rid of this 822,500. Okay? So I go ahead and identify down here in this section how much my ending cash balance would be if I didn't raise any new money during the year. You can do this a little bit differently. I like to do it like this. You must do it so that it balances. So I like to see how much cash do I need to raise in order to meet my requirements. And in this case, I have a requirement where I want to keep $200,000 cash on hand as a minimum at any time. In this case, running things the way we did resulted in a negative cash flow. We'll go through that in a few minutes. It resulted in a negative cash flow, which then I have showing as a negative cash balance. So that negative cash balance would need to be reconciled somehow. And I would reconcile it by, in this case, maybe raising some financing. And in this particular case, I've chosen to raise that financing through debt. So down here, I've identified that my regular cash flows, absent any financing considerations, just as I've expressed here, result in a negative $622,500 cash balance. I want to always have at least $200,000 cash on hand, which means I'm $822,500 underneath the amount I need in cash or the amount I need in order to balance my books and have the required cash on hand. So let's go ahead and see what's taking place here really that's causing this imbalance, because I see that the 822,500 is the same number as this 822,500 of cash to be raised. And the culprit here is in how I have gone ahead and allowed my long-term debt amount to reflect both the original long-term debt balance at the beginning of the period, plus any additional long-term debt, plus this amount that I say needs to be raised in long-term debt. Well, that's a problem because I'm saying that we're raising it, but notice I'm not inputting it here as though it's raised, and I'm also not inputting it here in additions to debt as though it's being raised. So I've got an incongruity. I can solve that incongruity a couple of ways. I have it set up here because I wanted you to see that there was an imbalance created. I wanted it to be very obvious to us, and I wanted us to then recognize it's because we've got a major cash problem because we have bled cash in this period of time. We've bought some significant amount of equipment. We've increased our receivables and our inventories. Yeah, we've had some profitability, but not enough to cover all of that. And so we end up with a problem. So how do we resolve this? Well, it's pretty simple. I'm just going to go ahead and get rid of this particular reference to the additional finance to be raised. I will leave this reference down here in the bottom right. So as a reminder to me that I need to raise money, as though seeing the terrible cash balance wasn't a reminder enough. But now, having done that, I now am back in balance. So in order to solve this, I realize I need to raise $822,500. So where is that going to be reflected? Well, I'll go ahead and suppose that if I'm buying $1 million of equipment, I probably can finance some goodly part of it. And I'll suppose I can finance the bulk of it in this case and say that I'm going to borrow $822,500. And when I do that, now I have reconciled my cash structure so that I don't need to raise additional money. I raised enough to keep myself at the $200,000 level. Recognize that I have a similar problem building for the next year, but we're going to come to that in just a moment. But here we were terribly out of balance. Now we're back into balance. Well, I think we've gone through most of the assumptions for the income statement and most of the assumptions for the balance sheet. And we see how they've given us an income statement. They've given us a balance sheet that works now. We have the appropriate amount of long-term debt because we took our original long-term debt balance plus some new long-term debt that solved our out of balance problem and that solved our terribly negative cash position. So now let's think about the cash flow statement. Well, the cash flow statement, as you recall, is an amalgam of the income statement and the balance sheet. And it's divided into parts of cash from operations, cash from investments, and cash from financing. And so let's walk through these. Here we're not calculating anything. We're really just doing cell references and putting these things together to come up with a cash flow. So as I do this, my first number is net income. Well, I take it right from the net income field, of course. We know that net income includes a deduction for depreciation, if there is any, and so we need to put that back. So we're having a positive contribution here to cash flow from depreciation. Where did we get that? We got it from the depreciation line on the income statement. As we go to increases or decreases in receivables, remember that we've got a negative correlation. An asset category, when it rises in nominal terms or when it increases, then it results in a drag or a negative on cash flow. A liability column or category, when it has an increase, represents an increase in cash flow. Well, let's see if that plays out for us here. So in accounts receivable, we started with our accounts receivable of nothing in the beginning period. We then, by the end of the first year, they had risen to 187.5. And just as we might have expected, that increase in accounts receivable represented as a decrease in cash flow. You know, the same thing happening for inventories because it's also an asset account. And here an increase from nothing to 150,000 results in a decrease here. And you've got a couple of ways of looking at how to represent this algebraically. What I tend to do is take the most recent period minus the period before. In this case, had I simply done that and stopped there, I would have ended up with a positive number. I don't want a positive number. I know it's counterintuitive. So I simply put a negative at the beginning of that. So I put a negative indicator at the beginning of the algebra when I know it should be a negative value or negatively correlated. And you'll see I did the exact same thing here for the inventories. Coming to accounts payable, well, we had accounts payable of nothing, and they increased to 112,500. That increase in accounts payable is the same as an increase in cash flow. And we've got the same thing happening over here in wages payable. So make sure that you remember that when we get to a cash flow statement, we are creating values based upon a change. So it really does represent the flow. And so as we add all of this up, it gives us a negative 122.5 for cash provided by or used by operations. As we go down to then investments, again, a firm invests in capital assets that it can use to make money. You'll recall having made an assumption that we were buying $1 million of new capital equipment. So as we come over here, we buy $1 million, we spend $1 million, it decreases cash by $1 million. So we pick that up as a negative value. And so we have to give it a negative sign to do that. If we had any other investments, then they would be picked up as well. We didn't have any other investments, so there's nothing there. And then we have a summation on those, and we then have cash provided or used by investments. And so I see here that in this year, I added $822,500 in debt. I did it because I was running such a horribly negative cash flow. And if I had issued new stock, it would have been referenced here. If I had paid any dividends or distributions, it would be referenced here. I then sum these, and for my cash provided used by financing activities, and then I then take a summation of the three categories of cash flow: operations, investment, and financing, and come up with my net increase or decrease in cash, which is my cash flow. Well, you would expect if we started with 500,000 and we had a negative cash flow of 300,000, that we would end up with a 200,000 ending cash balance, which in fact we end up with a $200,000 ending cash balance. And again, I've gone ahead and just referenced it here, but I could have just as easily said equals the prior period plus this change, and it would have given me the same outcome. Well, let's briefly take a look at the next year, and we won't go through each of these categories again. I just want to take a look at my cash situation and recognize what's going on. So here I see that I have a problem. I end up with a $30,000 cash balance. I say I want to have 200,000. So if I'm going to get that, then I'm going to have to go ahead and raise 169,675. So before just adding that into long-term debt or adding it into new equity contribution, let me show you what has to happen if you're making a change in any one of these sheets. We have the income statement, we have the balance sheet, cash flow statement, and our assumptions tab. So in this case, I would like to think about, instead of taking on new long-term debt, I'd like to think about going ahead and raising this 169,675 through credit line. But I need to have a credit line assumption represented on my assumptions tab. And if I have to have that, I have to have a credit line assumption on my financing activities, and I have to have a credit line on my balance sheet. So if you do something to the balance sheet, or rather, if you do something to the assumptions table that's going to affect the balance sheet, you also have to do something to the cash flow statement. Or if you do something to the assumption section that's going to affect the income statement, you then also have to replicate it on the cash flow statement and the income statement. So if you change it in one place, it must be changed in at least two others. So remember that, otherwise you're going to get yourself out of balance. And I'll show you an example of how I would go ahead and deal with a balance sheet issue and then separately a income statement issue before we wrap up. So let's go ahead and suppose here that we're going to increase the number of options we have on our assumptions table. And I'm going to add some space so that I can put in a credit line. I'm going to do the same thing over here in my, cash flow forecast. And then I'm going to go ahead and do the same thing in my balance sheet. And let me say this is going to be a credit line. Now I'm going to have to make sure that I pick up the right summations. So I've got to adjust this. So it's going to be equal to this plus this now. Let me copy that over. Let me do the same kind of thing here. So I'm going to say now we're going to have an addition or a reduction to credit line. And I have to identify where we're picking it up from. Well, here I'm picking it up from the section I'm about to solve or fill out here. So I am going back to my assumption sheet. I am detailing this out. I'm so far at zeros across this. Let me make sure that I'm picking up the right numbers here. So if I have a number in this category, it's because I had a number here. And since there is no number, it's going to come up as zeros. I need to make sure I copy that across so that I'm picking it up from the same or the appropriate place each time. And then with my credit line over here on the cash flow statement, I'm going to do the same thing. So now here I pick it up from what's happening in the assumptions table. And here I've also picked it up from what's happening in the assumptions table. So I'm clean now. I still show that I'm balanced, but let me make sure that everything's picking up properly. So I've got the right structure for total long-term liabilities. Now I still have the right structure for total liabilities. I still have the right structure for total liabilities and shareholder equity. I still balance. And if I now go ahead and say, let's take on for the second period, 169,675 in credit line balance. I've gone to a lender to do this, of course. I can put that in, and it's shown up over here on my cash flow statement. It is shown up over here on my balance sheet, and I'm still in balance. So that makes sense to us. Let's look at one other item. Let's assume that I want to add an expense line, and I believe that I'm missing something. I believe I'm missing R&D, let's say. So let me give myself an R&D line. So I'm going to insert a line here, and we'll call it research and development. But if I insert it here on the income statement or the assumptions affecting the income statement, I've got to come up here and represent it also on the income statement. And then I similarly have to make sure that it is being picked up on my cash flow statement. Now, because it's an income statement item, it is being picked up on my cash flow statement because it's being picked up in net income. So let's make sure that we're picking up all the right numbers. I'm going to have to change some of this because I have in my total operating expenses. I don't have the row 9 where that new number resides. So I now have picked that up. And I can say that I've gone ahead and made sure that my subtotal here is picking up the right line. Now let's go ahead and show that I pick up the R&D expense from my assumption. So I've got my research and development right here. I don't have a number there yet. I'm going to soon. Shows up as a percentage. Let me fix that. I don't like that being a percentage, of course. I've got it in the next line as well. And so let's say that these are being put in as nominal values. And let's assume that in this period we had no R&D in that first year. But in this second year, since we have already finished out the first year and reconciled it nicely, in that second year, we did want to have some R&D. And we can either have it as a percentage of revenue or as a flat dollar amount. I'm going to say that the company is just budgeting in a basic way and has decided that they would like to commit to $100,000 in R&D for this period of time, which immediately gives me another problem because I'd already reconciled my cash to know that I needed to pick up some money in a credit line. So once again, having done this, I now have my R&D expense increase. My net income has gone down yet further, and I end up with a net decrease to cash because of this. And I'm going to have to change this credit line now or get some financing, maybe long-term debt, maybe credit line, maybe equity to bring this ship back into the right condition. I'm just going to go ahead and add it to this credit line. So now it's 269, 675. And when I've done that, it's gone ahead and reconciled. I no longer have to raise any cash. I've got the $200,000 that I wanted. Yeah, I'm in a lot of debt, but we've invested in R&D. We've got $2 million of equipment. We have a loss still, but we're pretty early in our development. So hopefully this gives you an idea, a better idea as to how to flesh these out. So now we're looking at the cash flow model with all 5 years, and you'll see if you pay close attention that nothing has changed for years 1 and 2. This is exactly as we saw it in the model just a moment ago. So this is just an idea as to how you can look at some of this. Obviously, I cleaned this up a lot. I put it in better accounting format, put spaces where they belonged, got rid of spaces that didn't belong. That's just beautifying the thing. You need to have something that works for you and that makes sense. So 2 more things I want to cover before we finish this up. One is I'd like to take a look at this issue of loss carry forward and what you can do with it, what some of the rules are currently and how you should think about it. And then I want to take another look at what we've done as we've set up a break-even analysis and look at an option here. So you'll note that I've given you a part of the rule for loss carry forwards. If a business suffers a loss in a given tax year, then obviously it doesn't pay taxes that year, and that loss can carry forward in perpetuity under the current rules. In the next year, if the business has a gain, it can use up to, or it can use an amount of loss from prior years up to 80% of its gain. So if a business had a $100,000 loss in year 1, it would not pay any taxes, and it would then just bank that loss to go against future incomes. If in the next year the business had the same $100,000 loss, then it would book or bank another $100,000, so its carry forward would have become $200,000. But now let's assume that in the following year, the business has a $100,000 net income or gain. Well, it can only use amount of the loss carry forward equal to as much as 80% of the gain. So you could use $80,000 of the now $200,000 loss carry forward that we have amassed. So now that's going to then reduce the taxable income to $20,000, and it's going to reduce the loss carry forward by the $80,000 to $120,000. So now let's assume next year the business once again earned $100,000. It can use $80,000 of that $120,000 that it's banked. That's going to, again, reduce the taxable income down to $20,000. It will reduce the loss carry forward of 120 down to now 40,000. And if in the following year, we then had, again, a $100,000 income, now there's only $40,000 of loss carry forward remaining. We can apply that against 100,000, so there would be $60,000 of taxable income. So you can keep carrying any losses forward in perpetuity, and in any given year, you can use loss from prior years up to an amount equal to 80% of that particular year's net income. So, or rather that particular year's taxable income, excuse me. So now let's consider how this would apply for this particular company. Well, in this case, we have no taxable income for the year, so we're not using any of our loss carry forward, and we then are going to have a loss carry forward beyond that of the negative 135, and this resulted then, because I've got some math coded into this, in a taxable income of 0. Well, for the next year, we're also, because we're running a negative, or we lost money, we aren't using any of our loss carry forward, and we're now going to add the $135,000 carry forward from the prior year to the new loss for this year. And I believe that's going to give us a negative 244,675 with those numbers combined, and I still have a 0 taxable income. But now, for this next year, I can go ahead and use the entirety of this 244,675 loss carry forward. And it's going to not reduce my income, but it's going to reduce my taxable income. And notice that I'm pulling taxable income here rather than simply pulling net income. I'm pulling taxable income. And so I've got taxable income of 755, so 755, 230, excuse me. I've got net income. I've got taxable income of 755, 325. I can reduce that by the 244, 675. So I'm going to use all 244, 675, and my taxable income now becomes $510,650. The next year, I don't have anything I can use because I've used everything up in the prior year, and so now these just become zeros. Notice that I'm typing these in. I told you earlier that when excuse me, I told you earlier that when I have a relatively complex, unique situation that's hard to model, I might go ahead and highlight it in yellow and maybe do some manual calculations. If I was good enough at Excel modeling, I could figure out all the nested ifs and then and conditional statements and such to do this. I don't want to invest that kind of time on this at the moment. It's tax rules are changing. This changes based upon gains, losses, how much carry forward is, etc. So I'm putting this in yellow, and if it's in yellow, to me it's kind of an assumption, but it's kind of something you can calculate. So I'm fine for you to calculate these rather than have it all work like you would where we've just got strong assumptions here in green. Okay, finally, I want to think about the issue of break-even analysis. And I think we know that break-even analysis includes price, total fixed costs, average variable costs, which would be the price minus any cost of goods sold per unit, some expected profit. And if we're really doing true break even, so we expect a profit of 0, we just have profit of 0. And then we can solve, in this case, to the break-even quantity. So that's what I've done. I've solved using the total fixed cost plus profit in my numerator divided by price minus average variable cost in my denominator. Okay, so we have to think about, how did I get a little bit of this? Well, my total fixed costs, I'm picking up from the income statement. I'm not including the variable cost of goods sold, of course, but I'm picking up everything else that is hitting the income statement for this. So I'm picking up my operating expenses, including depreciation, because it is an operating expense, any interest expense I might have, any tax I might have. And I could expand this to say any operating expenses outside of cost of goods sold, any non-operating expenses, and any income taxes. Those become my fixed costs for the period. And if those are my fixed costs for the period, then I realize that I have a break-even quantity of $31,750. And I'm simply repeating that through the rest of my schedule. Well, in this first period, we have 25,000 units that we are expecting to manufacture, and well under the 31,750 units that we need. And so, of course, we're going to lose money. And in the second period, we have a 100,000 unit expectation. Our break-even quantity is 105,350 units. So we're again going to have a break-even negative situation. We're going to have a loss because we're not making as many units and selling as many units as we need to. We haven't reached our break-even quantity. In the following periods, we more than meet our break-even quantities because we have 150,000, 200,000, 200,000, and we only needed 123, 171, and 166. Okay, so there's something in here that we don't talk about in Business 101. I'm not sure how much you talked about it in your accounting classes, but it's relevant. This total fixed costs includes depreciation. So sometimes you'll see people create a break-even analysis with and without depreciation. So I've gone ahead and I've already done that. And I had those rows hidden. I just let us reveal them. But I think it's important because we can see that if we do break-even analysis without depreciation, a non-cash expense, that the number of units required goes down dramatically. In fact, in this first period where we were at 25,000 units and lost money, if we had that same 25,000 units but no depreciation, we wouldn't have lost. And think of this more as a cash loss than a net income loss. So I think it's instructive to run break even sometimes with and without depreciation. So we've looked at the taxes, we've looked at depreciation, we've looked at break-even analysis. We've been all the way through this 5-year model, and hopefully this has helped you in a big way understand how to use these models.